losses of the year on Monday as the shockwaves from a major bank collapse in the U.S. spread around.
In the U.S., where some of the world's leading money managers are warning the collapse of another American bank could lead to a credit crunch.
Breaking this morning, First Republic Bank has become the second largest bank failure in U.S. history. Regulators have seized the bank.
It's really a flight to quality, and the fact that the big banks are going down so much, I think, is creating that opportunity.
Hello, everyone. Have you ever thought that how banks earn money? Today's topic is about this only. All of us save our money in banks, and these banks pay us interest on our savings. So how do they get money to pay us? And how these commercial banks make money by providing and earning interest from loans such as mortgages, auto loans, business loans, and personal loans. Customer deposits provide banks with the capital to make these loans. Actually, the banks uses your money to give loans to others, and the interest that they charge on that loan is their earnings. Suppose there is a bank. There is only one customer in this bank, and that's you. You deposit $1,000 with the bank, and the bank pays you interest of 4%. Your $1,000 is now with the bank. Now the bank gives out this $1,000 to some other person. The other person wants loan for personal needs. The bank charges interest at the rate of 8% from the borrower. So the $1,000 of the bank went to the other person. When the other person pays the bank $1,080, then bank will pay you $1,040, and the bank earns a profit of $40. Basically, it works like this. But this begs a very important question here. What will happen when the bank has given $1,000 to the borrower, and the due date to repay the loan hasn't arrived yet, but you urgently need to withdraw your whole amount? Now, the bank doesn't have the $1,000 with it anymore to give you, or due to some or the other reason, person cannot repay the loan, your money is lost. These situations are truly very problematic for the banks. Yes, it's right that no bank has only one depositor and one borrower. They are many people. Still, each bank doesn't keep most of its money with itself. Instead, it gives out the money as loans to people. That's why the bank has a rule. Of all the money deposited by the depositors with a bank, the bank has to keep at least 4% of it with itself as reserve. This is called the cash reserve ratio. So bank decides what should be the cash reserve ratio. Also, it keeps changing with time. Some time ago, it was around 3.5%, but now it's 4%. Commercial banks offer basic banking services, including deposit accounts and loans to the consumers and small to mid-sized businesses. The banks make money from a variety of fees and by earning interest income from loans. Banks have traditionally been located in physical locations, but a growing number now operate exclusively online. Banks are important to the economy because they create capital, credit, and liquidity in the market. Banks also earn specific commissions for distributing mutual funds or insurance products to their consumers. Typically, banks earn their profits by acting as a bridge between borrowers and depositors. At the same time, they incur various expenses for carrying out operations. In case borrowers default on loan repayments, banks have to cover the losses by utilizing their earnings. Banks make money from service charges and fees. These fees vary based on the products, ranging from account fees, monthly maintenance charges, minimum balance fees, overdraft fees, and non-sufficient funds charges, safe deposit box fees, and late fees. Many loan products also contain fees in addition to interest charges. With the rise in internet technology, most banks now allow their customers to do most of the same services online that they could do in person, including transfers, deposits, and bill payments. Automobile lending is another significant category of secured lending for many banks. Compared to mortgage lending, auto loans are typically for shorter terms and higher rates. Banks face extensive competition in auto lending from other financial institutions, like captive auto financing operations run by automobile manufacturers and dealers. Moreover, credit cards are another significant type of financing. Credit cards are, in essence, personal lines of credit that can be drawn down at any time. Private card issuers offer them through commercial banks. Visa and MasterCard run the proprietary networks through which money is moved around between the shopper's bank and the merchant's bank after a transaction. Not all banks engage in credit card lending, as the rates of default are traditionally much higher than in mortgage lending or other types of secured lending. That said, credit card lending delivers lucrative fees for banks. Interchange fees charged to merchants for accepting the card and entering into the transaction. Late payment fees, currency exchange, over limit, and other fees for the card user, as well as elevated rates on the balances that credit card users carry from one month to the next. Basically, it is a system that allows the exchange of funds between financial market participants such as lenders, investors, and borrowers. Financial systems operate at national and global levels. Financial institutions consist of complex, closely related services, markets, and institutions intended to provide an efficient and regular linkage between investors and borrowers. Now the question arises that, what if all the depositors of the bank want to withdraw all their money from the bank? The bank will fail then. This is called as the bank run. And it is not possible for any bank in the world, because no bank holds all the deposits with itself in cash. It doesn't happen realistically, so there's nothing to be afraid of. A bank run occurs when many clients withdraw their money from a bank because they believe the bank may fail in the near future. In other words, it is when, in a fractional reserve banking system, where banks normally only keep a small proportion of their assets as cash, numerous customers withdraw cash from deposit accounts with a financial institution at the same time because they believe that the financial institution is or might become insolvent. When they transfer funds to another institution, it may be characterized as a capital flight. As a bank run progresses, it may become a self-fulfilling prophecy. As more people withdraw cash, the likelihood of default increases, triggering further withdrawals. This can destabilize the bank to the point where it runs out of cash and thus faces sudden bankruptcy. Several techniques have been used to try to prevent bank runs or mitigate their effects. They have included a higher reserve requirement, requiring banks to keep more of their reserves as cash, government bailouts of banks, supervision and regulation of commercial banks, the organization of central banks that act as a lender of last resort, the protection of deposit insurance systems such as the U.S. Federal Deposit Insurance Corporation, and after a run has started, a temporary suspension of withdrawals. These techniques do not always work. For example, even with deposit insurance, depositors may still be motivated by beliefs they may lack immediate access to deposits during a bank reorganization. Due to the failure of repayment of loans by the borrower, there's a limit on the amount of money you can withdraw in a month. More or the less, this is a huge source of income for the banks, the difference in the interest rates. So this is how a bank works and earn money. Hope you like this informative video and do share this with your friends. Stay tuned for more videos like this and subscribe our channel. Also hit the bell icon to get notified when we post the video. So goodbye guys for now. See you soon.